A very good morning to everyone. I think this is a very interesting topic that we're going to uncover over the next 30 to 40 minutes. I don't see a timer over here, so someone should keep us honest on time. Credit scoring obviously has existed for decades, right, if not more. But the nature in which credit scoring has evolved is something that we want to unpack and what lies ahead, right? So we really look at credit scoring. Obviously, the initial models were very rule-based, but I think there are two vectors in which some of those models are evolving, right, over the past few years. The first vector is the transition from rule-based algorithms to AI, ML-driven algorithms. And the second vector is inclusion of a lot more data points, which are typically not conventional data points in nature, right? From the standpoint of understanding the financial history or the credit history of the customer, there are alternate data sources available which can give you good indications related to the credit history of a specific customer or a corporate, right? So both of these are very interesting vectors that are getting unpacked from the bureau perspective, but also from the standpoint of other workflow integrators, solution providers, et cetera, to provide meaningful insights, right? And I think that is the landscape that we want to unpack here, right? And with us, we have esteemed industry veterans over here. So I want to try and unpack this systematically. So Deepak, maybe in no particular order, maybe I'll start with you and get your thoughts on how this has actually evolved from the standpoint of credit bureaus, right? And you have visibility into how the credit bureau operations work, et cetera. So keen to get your perspectives on inclusion of AI/ML in the context of credit scoring.
Yeah, I think we are all seeing the formalization of economy because of the whole digital footprint and the availability of data, the way financial institutions now both respond as well as they consume the data that bureaus provides. And at the same time, bureaus are also realizing basis the way the data is used and delinquencies or NPAs, how do they take that input and relook at even their model? So nothing is a constant or a static today the way be it the bureaus are looking at it or be it the institutions consuming the data that bureau provides. So I think that's the first thing. The second, what we are seeing is the data that used to, for example, go once a month from lenders back to the bureau now, that has become fortnightly. I'm hoping there will be a time very soon where it may be in real time. It won't be even a day lag. That also means that the velocity of data will change and also the veracity of data, because it's not about just taking data in, but also to verify and ensure that the data that is getting taken in is verified, be it for credentials, be it for detailing. And we today find at the industry level, a lot of data that comes out of bureau is not necessarily pristine. And customers' grievances around the data or the way data ingestion happens, the whole engine needs an overhaul. And I think in context of that, I see the AI/ML applications that industry is putting together will help identify certain patterns, identify the sources, identify the data coming in from sources where there is a mismatch, because you're also now looking at PAN is not the only source against which you match. PAN was still easier because from duplicity, but moment you are now getting a data from a microfinance institution where the identifier is a voter ID. Now think of it, you are also adding now the next source of data on which getting a dedupe done is extremely difficult, because at times the documents are bit smudged, the information is not verifiable electronically. You probably are creating multiple records of the same user in the system. But then you have certain patterns, and that's why if you see today the stress on MFI, which even regulators have flagged, that there are lenders have done 3 or 4 loans to the same customer or a borrower. Uh, could this be protected? Answer is yes, if lenders would have had access to verifiable data in real time. If any of these data duplicity through AI ML could have been avoided, looked at patterns, looked at sources. And I think, yeah, that's where not just verifying the data, but also validating it and looking at the scoring model. All of these is going through a constant change at Bureau's end.
That's great. And I think, see, one of the themes that I got from you is obviously there is the AI, ML modeling and other aspects, but all of these fundamentally come down to being a data problem, right? And the interesting that you talked about, which is a constant struggle in financial institutions, is how do you dedupe a customer, right? And what are the mechanisms that you're using to actually get a golden copy of the customer identified? And it still continues to be a challenge. Even more so now because there are alternate sources of information available which might keep various non-conventional IDs as your unique identifier of a customer, right? So interesting. We'll build on that. But if I come to you, Natarajan, in the context of CIBIL, obviously you're in the throes of some of these advancements, from a TransUnion CIBIL perspective. And you also have a platform, I think it's called True Some. Yeah, I would like to understand what you're doing in that platform, general advancements that you're seeing from your perspective and from your vantage point.
Thank you. Good morning, everyone. Now, before I start and explain, I think a couple of myths which I would like to and I put this connotation very nicely here. So you talk about AI, right, which is artificial intelligence. But if you converse it, it's IA, right? Now, IA is what? It's intelligence augmentation. So AI has to get used for intelligence augmentation and not for replacement. Now, that's a very critical aspect of using AI, particularly in the context of credit scoring and models and all of that. Now, there are obviously huge advancements done in AI. AI has been there for many, many years. It's not that we've not been using AI. Even traditional logistic regression models are known as AI models, right? So it's not been there many, many years. But in terms of a credit bureau perspective and from a data modeling or a credit modeling and also the platform, we obviously have a good investments on a platform called as OneTrue. And if you look at a study of a credit scoring model, right, the maximum time spent in a credit scoring model is the data cleanup, the data exercise, and the feature engineering, right? The actual credit modeling is only a 25-30% of the activity.
Exactly.
But 70% of the activity goes in only data massaging, data collation, feature engineering, and all of that. Now, traditionally, what you'll have is you will have an analyst who will look at tons and tons of data and start creating variables out of that tons and tons of data. And there is a limitation to the human mind, right?
Yes.
Now, that's where AI is helping us because then you push in a lots of data. For example, as credit bureaus, right, we ingest close to 2.5 billion records a month. We manage records for around 65 million borrowers. We manage tons and tons of information across consumer, commercial, and MFI. Now, the important aspect is how do you use this structured data? Obviously, credit bureaus works more on the structured data element, but even within a structured data element, how do you create feature engineering as an aspect? So that's where platforms like OneTrue is going to help, wherein we can help lenders create multitudes of feature engineering in a jiffy. So you don't have a person going through each aspect of it, and then you can do all of that. Couple of other advancements and features in a platform like OneTrue is also about the explainability AI, right?
Yeah.
So for example, you can create rules, you can create workflows on it, and basis the Gen AI, it will throw the next steps out of it very logically. So those are some of the advancements what we are trying to do in India through OneTrue platform.
No, that's excellent, right? And I think I'm glad you touched upon Gen AI. It's a topic that is close to my heart. And I often talk about how, Gen AI and AI do different things, but they are complementary in nature to give end-to-end value, right? So I think that's an interesting take. Just to ask one question to you, right? See, obviously there are conventional data sources on which you can apply AI and ML, and it can give you more holistic interpretations of data. But are you also looking at getting non-conventional data sources into the fold as you evaluate the credit worthiness of a customer or a corporate or whatever? Is that something which is on the cards? Is it already happening?
Not really, because there are regulatory guardrails and
Yeah.
guide rails on what data elements credit bureaus can ingest.
Yeah.
So we obviously work on a very structured information which has an approved norm by the regulator, and that's what we ingest on. But having said this, we do a lot of consulting engagement with multiple banks, wherein we obviously look at a lot of other forms of data like the bank statements or the GST returns or the income tax returns, where you have a lot of unstructured information coming in, right?
Yes.
You have the bank transactions. Now that is where AI helps in reading through tons and tons of transactions, creating some sense out of it, and then creating variables out of it. So that's why we are working towards it.
Got it. And that's where maybe I'll get you and Shailesh. See, from a platform integration, from a product perspective, when you look at Jocata, obviously one of the things that you would be doing is integrating AI-driven workflows across the front to back value chain, right? From that standpoint, if you look at credit worthiness and credit scoring as one of the elements in that value chain, how do you see those integration points, et cetera, evolving from your perspective?
Sure, that's a great question. To those of who don't know about Jocata, we are one of the leading digital lending platform providers to the BFSI industry. So we've had a ringside view of what's been happening in the country in terms of the digital public infrastructure evolving, the kinds of, obviously through our banks, we have connectors into the bureaus so that we are able to pull credit bureau scores and run the models and credit policies for our lending partners. But interestingly, in the overall digital lending value chain, artificial intelligence is a fairly broad umbrella, right? I mean, we've been using various capabilities. To give you some examples, we use a platform has computer vision algorithms that are used for face match and liveness detection and things like that when you do video KYC. We use natural language processing to understand bank statement transactions, financial reports that come to us in structured and unstructured format, to make sense out of them, to classify transactions, and to really augment, to borrow a term that Natarajan used, to really help the underwriters come to a decision faster, and also reduce fraud risk in the process.
Yeah.
I just want to touch upon this idea that India is largely a new to credit and thin file country, right? We are bureaus are still improving their penetration. The formal economy is still in the process of formalizing, and we still have a long way to go. What that means is there is still a lot of informal borrowing that happens. And if you look at it, right, at the heart of it, what credit bureaus do is essentially look at your ability to repay a loan and your intent to repay. These are the two main things that you're looking at. And most of us exhibit these behaviors through several different proxies, like we make our bill payments on time. So utility bills is a great proxy to kind of a data point that you can now use. We make our tax payments on time. Like all small businesses that are GST registered have to make monthly or quarterly payments.
Yes.
So now you have a steady stream of data points that is available, that is digitally accessible, that is structured, and it has a great correlation with your credit default behavior. You have to extract the features from those data sets. You have to do a lot of back testing with your existing portfolios and build AI-based scores that are behavioral scores. So at Jocata, we pioneered two very industry-first sort of scores. One is a GST-based score called SME DNA. Another is a bank score that looks at your bank statement data, 12 months of bank transactions, to come up with a score that allows a lender to lend with confidence because the correlation has been established and the cutoffs can be chosen in a way that your overall portfolio level NPAs remain below a certain percentage. So a lot of work, almost 6 years of work has gone into this. It requires a lot of back testing with the banks, with the lenders. It also requires consent mechanisms to be available because not all data out there can be used, and I'm sure DPDP will help define some of that. But so that, I think to come back to your original question, I think AI has been getting infused into lending processes now for a few years. The different kinds of AI, so machine learning, NLP, as well as computer vision algorithms, all of these together have made the process a lot more efficient, a lot more accurate. And I think the next step is to build these AI-based credit scores, which can augment the overall credit decision.
Perfect. And I think you touched on consent and you touched on DPDP. I think they're going to be important ingredients and components, right? Because at the end of the day, there's an increasing level of sensitivity around what data gets used and how they get used. So the capabilities obviously exist today, but it has to be looked at in the context of how you can tap into appropriate data sets with the right level of consents, right? So that's great. And then Abhishek, finally to come to you, I think the lens that you will provide is going to be a very different lens, right? Because you're going to be providing the lens of a consumer, right? From Shriram Finance perspective. Obviously, when you look at the overall credit operations process, keen to understand, how are you seeing the whole credit underwriting process evolve? Obviously, credit scoring is an integral part of credit underwriting. And I'm sure the clientele that you serve will be a combination of credit visible and credit invisible, customers, right? So how do you really see this field evolving where, and that's the topic, right? It's about increasing accessibility of credit in India and primarily with a focus on credit invisible or semi-visible customers, right? So keen to understand your perspectives on your vision, how you're trying to drive that.
So just a small correction. I'm not from Shriram, I'm from Julius Baer.
Oh, you're from Julius Baer, I'm so sorry.
No,
apologies.
Yeah. So this is a ultra HNI and HNI wealth management business, but lending forms a sizable part of our offering. And what I wanted to touch upon exactly as you said is another vertical, right? So within credit scoring or credit worthiness, right? One part is the repayment capability. But if you're doing collateral-based lending, the second is the scoring of collateral itself. So that itself becomes another big parameter, right? So if you're, let's say, in a collateral-based lending, if you're going to bring collateral, which could be in the form of securities, which could be very dynamic, right? And that's where we are trying at this stage working on using an AI/ML model because every client is bringing different kind of portfolio. And we want to not have simple state rules being applied, but see that what's the type of the portfolio which has been brought in place and how we can get the right LTV, which is loan to value assigned, and hence be able to also ensure that our capital reservation is less. So that's one area. And similarly, if you look at loan against property is another interesting area where AI models are being assessed. Right? Because what happens when you do mortgage, the value is always defined of the collateral basis, what you're going to sign on the agreement. But when you're doing loan against property, the property was bought a few years back. Right? Today's value would actually depend upon the area, the metrics, the economy of that city, how the city is growing, how that area is working. So getting all this data, and which a lot of that is available through government-based APIs now. So you can actually go ahead, fetch what were the last 10 registrations or the deals which were done in this base. And then go ahead and see what is the prospects or what are the quotes being placed on various brokerage platforms, the retail brokerage platforms like Magic Bricks and others. And then try to run models and say, okay, what could be the right value of this collateral to give loan against property? So that's the things that we are assessing at this stage.
Excellent. And when you look at it from a kind of wealth management perspective, the overall value chain of wealth management, obviously there are other areas within the wealth management lifecycle where you are going to be using AI, just from the standpoint of understanding customer patterns, customer behavior, customer experience, which also will have a bearing on some of the credit decisioning models, right? Because the payment schedules, the repayment schedules, etc., the credit profile of the customer, over the course of your relationship is also going to have a bearing. So are you also tapping into some of those areas?
Yeah, in fact, significantly, right? I mean, just to take a share of current scenario, right? We have been in a bull market for some time.
Correct.
So everyone remains invested. Now, when everyone wants to remain invested, how do we go ahead and help him get more invested? And that's by seeing that what's the portfolio which is invested. Take that as the collateral. Go ahead and then see, okay, how his repayment pattern, what his holding pattern has been, right? Which clients want to churn their portfolio more, which clients want to actually keep it remaining invested. And how do we go ahead and which want to buy small stocks, which want to actually buy cheaper stocks, which want to buy long-term stocks, and then try to see, okay, what's the right value which we should assign to them.
Perfect. No, that's great. So I'm just going to do a quick time check. How much?
We have 20 more minutes.
Fantastic.
We are planning to dedicate the last 10 minutes for a Q&A.
Sure. So we'll uncover a few more topics in the next 10 minutes and then open it up to the audience to see if there are specific questions that can be taken. But see, I think what you would have seen is over the course of these interactions that the potential is immense, right? And there are multiple angles in which we are attacking the topic of credit scoring, specifically, but also a little holistically. But obviously, there are challenges, right? And there are implementation challenges, there are regulatory challenges, there are traditional challenges that you would associate to any AI-driven models, right? Be it bias, explainability, AI governance, etc. So I just wanted to unpack that topic a little bit more for the next 10 minutes before we open it up for Q&A. So Deepak, from your perspective, any thoughts around what are some of the inherent challenges that we are expected to see as an industry, which we will have to overcome over the next 2, 3, 4 years?
Oh, many. In fact,
Top three.
Everybody is concerned about the unsecured lending and the way the distress. Today you would have seen again a couple of banks have come out with their results. Look at the way markets are pricing all the bad news on the portfolio, and mostly the performance of every financial institution today is linked to how they are managing their asset or the lending book. 3 quarters back, everybody was talking about the deposit growth. Today, everybody is talking about how much more stress do you have in your book. So, being again on the board of a bank and on board of credit bureau, I get to see both sides of the story, and I think that's one single biggest concern. And at the end of it, you want to grow profitably, but there are a new set of matrix on risk-adjusted return and pricing that has come in forth by regulators. So every lender has to start now looking at what is the risk associated with certain kind of customers, certain kind of tenure, with collateral or without collateral loan, and thereby build a pricing model which is transparent, but at the same time, you are able to assess and continuously score risk in the real time. So it's not just about the data that you get from bureau, but it's about what kind of lending practice are you putting in, and thereby you are able to continuously measure that. We are also seeing risk coming out of certain states. So there are not just customer profile risk or the kind of loan, but also there are geopolitical risk within the country.
True.
So I think the way a farm distress in Maharashtra or in UP may create bad loan, that's something again one needs to start looking at, where the data is about weather, it's about crop, it's about what are the agri distress for which the end consumer has borrowed. Also, we are seeing that the whole early warning system needs a lot of work. It's not about just lending and hoping that customer, because the scores were good, you chose a call, because it's a risk that you have to continuously track through the tenure of the loan. So if the loan is for 1 year or 3 years, you have to assess that risk on a day-to-day basis. The last, I would say, there are many, but I'm just picking a few. What is the end use of money? I mean, today there is a lot of discussion that unsecured lending went through the roof because people were borrowing it here and they were betting in the stock markets. So the money was taken in for a very, very different purpose, and that's not necessarily what lenders were aware of. So unless the traceability of the money and the purpose for which the borrowing was done is tracked, you will end up seeing a lot more risk. And I think every single area, while AI is a separate topic in itself, but I'm saying if you are looking at data, trends, patterns, and you want to make sense of it more real time to control risk, it's possible, and I think that's where a lot of work needs to happen now.
Makes sense. I think there's a lot of business-oriented risks that you've unpacked. But
yeah. So coming to your question on the 3 top risks, right, of AI.
Correct.
I think I'm going to structure this into 3, which is one is the consent architecture.
Correct.
Right?
Correct.
Now, there were entities many years ago, right, who used to read Facebook posts and then used to create a credit scoring model out of it. Right? There were entities who used to look at email data and then create credit scoring models. So consent architecture is going to play a very, very big role on what is the consumer giving, how authentic is that information, and how can it get used, right? Second is the privacy, right? Now, consent will follow with the privacy. Now, from a privacy perspective, it becomes very important that if a consumer is giving consent for a certain thing, but a certain entity or a lender or any institution is using it for something else, then you are violating the privacy norms for the individual, right? So I think the couple of risks will be the consent, the privacy aspect of it, and the last aspect of it will be definitely the biasness, right? Because as you churn lots and lots of data, there could be some biasness in some pockets of consumers which can come in, right? What will help, there are pros and cons of AI. There are AI tools which helps address the biasness in a certain way, but the people who use AI has to also have ensure that there are proper governance matrices around all of this to cover and to ensure that the risks are well mitigated.
Absolutely, and to extend what you just said, right? So two things, right? One, see, the biasness can be controlled to a certain extent if there is appropriate explainability elements built into the algorithms, right? So, and obviously, people are still trying to crack explainability. Right? It's not well cracked yet. So that's an ongoing issue. See, and the other thing is, you talked about intelligence assisted and keeping human in the loop, right? I think that's going to be an important consideration because as you start making AI a lot more prevalent within your value chains, what's going to happen is you're going to become invariably a lot more dependent. And when you're going to become a lot more dependent, the human in the loop quotient should be managed appropriately, right? Otherwise, what will happen is, invariably the level of human involvement in some of these elements are going to, organically reduce, which will increase a certain level of risk profile in whatever you're doing. So how do you, have a very deliberate framework in mind and a very deliberate focus on actually keeping that human in the loop till such point in time, this whole AI thing is absolutely mature, which is not going to happen that soon, right? So I think that's going to be an important element, I think,
that's going to be governed by a lot of governance practices, which every institution does it. So your model governance, your people governance, all of that will play a very, very big role that how people is in the loop so far and don't leave everything to AI.
Correct.
That's why I think AI has to get used for IA and not for replacement.
No, absolutely, I think it's a wonderful one. From your perspective, Shailesh, when you look at integration, workflows, products, specifically in the context of Jocata, but also otherwise.
Yeah, I think I'll just expand a little more on what Natarajan touched upon. I think for those of us building AI-based credit scoring models, bias in data is a real problem. And I think it's not just the training data set that you chose to, you do normalization, you make sure that the data is not biased when you train the model, but also these are machine learning algorithms that also evolve. They learn from the data sets that they are fed eventually over a period of time, which means you need model governance, you need retuning on a periodic basis to make sure that, to give you an example, see, your model could be biased on gender, on geography, on age, depending on what data you fed, right? And you might invariably end up with some unfair credit practices, unfair lending practices, because if you don't have enough visibility into the model, if you don't have enough visibility and governance structure around it to make sure it is still performing within lending norms. And that nicely dovetails into explainability in AI, right? You need AI, it's called the black box problem, right? AI for most practical purposes is a black box to most people, but the regulatory posture on that will decide how effectively it gets used by lenders. Because if a regulator says, I'm not okay with you using a black box, you need to be able to tell me what are the features, what are the variables that contributed to a accept or a reject decision on a particular loan application. So those tools have to be, I think, a little more mature in terms of just for lenders to understand. And there are visual tools available that kind of break down the contribution of a particular feature or a parameter towards a yes or no decision. And also to be able to explain that when you have an RBI audit, right? That's an important one. I think regulatory posture in this case needs to evolve, and we need to have more clarity in terms of acceptability of these AI algorithms for credit scoring.
Absolutely, I think that's spot on. And then coming to you, Abhishek, and maybe this is the final one before we throw it for Q&A. See, I'm also interested to explore, how this actually changes from a wealth perspective? Because see, the kind of clientele that you're dealing with is not a mass market client, right? So these are premium clients, high net worth. And as such, there is a lot of human in the loop. There's a lot of human touch. There's a lot of relationship in the mix, right? You have relationship advisors, etc., in the mix. So obviously, when you're using AI, you are going to have to use AI with a lot more caution, right? Because that explainability element, to your point, becomes a lot more important in your business. So how are you trying to unpack that aspect? Is it more a case where you're using AI to assist your relationship advisors who can then have a discretion on what to leverage, what not to leverage in their conversations with the end customer? And that could be one way to look at it, but keen to get your thoughts.
So actually what you picked is exactly the place that we believe AI is helping our relationship managers and will help a lot, right? One, what happens is when these are HNIs and ultra HNIs clients, you don't get multiple opportunities. They are also not the ones who are running after us. We are running after them.
Exactly.
So you need that one specific moment, even if it's lending, right? To crack it. So we want to use these tools which rightly help them in prospecting. On the lending side as well as on the other areas in terms of relationship management also. But primarily on lending, like saying that if this is the portfolio, how effectively I can come out quickly and share you what's my quote. Because they're very, very finicky, right? I mean, the wealthier the client is, the more finicky is on the margin. You can go ahead and push saying that I'm going to give the loan at 12% to a normal client. You cannot go and push your rates to a HNI client. Because one, he has a lot more options available. He understands the market more, right? So he's picky to the specific 5 bips that I'm trying to make on the loan. So then to be able to help our relationship manager to have a right conversation in terms of saying, okay, how am I dissecting your portfolio? Why am I positioning this loan at this point for your collateral and for the portfolio that you're bringing in? Helps a lot for the relationship manager to convert that prospect into a client immediately.
Excellent. That's great. I think without further ado, let's open it up to Q&A. Keen to get your perspectives.
Yeah, hi, I'm Himanshu Sasteva from Global Payments. This one thing I wanted to ask, like AI is as good as the data you feed in, and I think we did talk about bias in data, and I think there are ways to probably handle it through normalization of the techniques. My question is more about, there is still a significant number of people who do not have digital footprint at all. So don't you think like if our credit scoring systems are like AI driven, data driven, then those people who do not have very strong footprint would be, probably they'll get loans probably at a higher rates, and there is unfair, benefits to those who have got a very stronger digital footprint. So it may probably create a huge gap. Instead of bridging the gap, it might create a bigger gap between those who do not have strong digital footprint and those who are probably very active in the world of digital technology.
See, I have a perspective, but does anyone over here want to take that question? And I can chime in.
So you're right. In terms of AI, obviously works on tons and tons of data which is fed in. But there was a point which Shailesh made, which is the credit invisible piece or the thin file consumers, right? Now, obviously, they are not credit tested from. They don't have a credit this thing, but there are tons and tons material available wherein you can do a lot of synthetic data creation, right? So you create a lot of synthetic data on those consumers, and then you train your models on it. Now, obviously, when those consumers are going to any lender, they are giving some sort of an information to assess, right? It can be as simple as a bank statement, right? Now, a lot of work is also happening on UPI transactions, for example. Now, given the boom of UPI, all the UPI transactions available in the bank statement. So you can create a lot of synthetic data around, and basis that you can train the models. The most important aspect in a credit invisible or a thin file consumers is that the model governance has to be almost 10x more of what you do on a credit tested model. So the model governance aspect of it, that if you're monitoring a model, say once in 6 months, a thin file consumer, you have to monitor almost like a monthly basis to ensure that those consumers are not getting unfairly treated. So that's one way to do it.
Yes, and this was a very specific example, and thanks for that, right? See, my perspective is, you might not be digital in nature, but given the way the world is today, you're still leaving a digital footprint, right? Every Kirana person has a way to access UPI payments today, which in itself is a digital footprint, right? So that person might not be digitally savvy himself or herself, but there are ways and means by which digital footprint is being left out there for us to consume through obviously appropriate consent mechanisms. So I think my point is, obviously there are conventional credit and financial information and data available, but then to the thin file consumers, etc., there is still a lot of digital footprint that these filers are actually leaving through the very nature of transactions that they're executing and transacting the world, right? And it is those data points, it could be tax returns, it could be UPI payments, it could be a bunch of other things that can be leveraged as proxies to then start building a credit profile, right? And that's where building the right models and having the right governance and looking at refreshes, etc., in a more frequent basis becomes very important, because you can also go wrong there. So we have to just look at it from that context.
I'll just add 2 sentences. I think what your observation is correct. If you do not have enough data about you, you are at a disadvantage. So that's one way in which the whole formalization of Indian economy, getting retailers and merchants to file GST, encouraging people to make digital payment, all that has happened. So there is an incentive for consumers to go digital. And let's not shy away from it, because if I don't know what you do, I don't know your ability, if I don't know your intent, and if I don't know the purpose for which you are borrowing money, you will not find easy credit from anyone. And that's the reality. Okay, so this is not going to be divide. It's, I think, to nudge or encourage people to be part of more formal economy.
And I think I completely agree with what Deepak said. I just want to add that you have to take a segmented approach. See, AI is not the be-all and end-all of everything, right? You can't have a single model that addresses the credit needs of the entire country. So the way you would assess, let's say, a small merchant in a Gurgaon or a Delhi, versus if you as a lender are trying to give a crop loan to a farmer in Andhra Pradesh, right? The kinds of data sets that are leveraged, and we have great examples in Kisan credit card and farm loans, right, where satellite data is now available. The yield per hectare of that particular, you can geotag and geocode that particular farm, and you're able to get data sets on what is the average yield per hectare on that. You can go and look at the minimum support price of the government and arrive at some sort of a triangulation of what is going to be the income of that farmer. Now, this is not necessarily AI, but this is now that we are in a data-rich ecosystem, there are ways that lenders leverage this data, and maybe an AI model will eventually evolve on top of that. We may not be there yet, but I think you have to look at it, take a segmented approach to it. And you can't have a single model for 1.4 billion people that works.
Hi everyone, my name is Amit. I represent Simple Works. We are into enterprise CRM application space across BFSI segment. And we are doing a lot of use cases based on the CRM data which we capture and using the AI models, right? The couple of questions which are coming from the clients is that whatever output is generated through AI, can I trust it blindly? Or again, on that particular output, I need to put a human mind, right? Because finally, I'm dealing with a lot of suggestions which regulatory framework I need to carry on. Similarly, when we try to do some use cases with wealth management, the same question is, as a retail investors, I need to know which stock I need to invest. And if AI model suggests me, comes into a regulatory framework, right? And so how to address this particular regulatory framework coming into, and again, AI output, blindly trusting it, is it fit into regulatory framework? How to go about it?
just want to say one thing, that nobody should trust outcomes blindly. You should do your back testing and satisfy yourself that the model works for you.
And I think that is true irrespective of whether it's AI or non-AI, right? I mean,
Yeah,
ultimately-
no, I think just two things, since I also am on the advisory board of one of the large global AI firms. Two things we see. One is any data that is being thrown which is traceable and auditable as a part of an outcome, you can take it, because there is always a back-end traceability available and the logic available. So if AI is a black box, answer is no. If AI is giving you a path through which it deduced or arrived at an outcome, answer is yes. The second part is about the models. Different entities or institutions will take inputs and build their own models, especially if it's for financial institution. Going forward, all models, and globally this is the practice, even in India it will happen, it has to be auditable at a periodicity. So you just cannot have a model without accountability and auditability. So say Julius Baer, Abhishek's team may use the same data and predict a very different outcome, or some other wealth manager may, but they will get audited. So at the end of it, whether you use AI or not, the accountability will rest with human, because the models will be designed by humans. Models won't be AI models.
We take the next one. Yeah, absolutely.
Thank you. My name is Saurabh. I'm from IndusInd Bank, and this is an interesting use case that gentleman from Julius Baer actually told us, that the models can also be used to evaluate the collaterals, the underlying collaterals, and probably this encompasses the credit scoring model for the person. We have already dealt in specific use cases wherein we score the consumer per se, the client per se. But when we talk about the collaterals, and specifically when we talk about collaterals which are physical assets in terms of land and land space or a building or a entity, the digitization of those records is not fairly at a mature stage, particularly in India. So what I intended to ask was, what's the realistic time frame? Because it certainly will help the banks and many more lenders to reduce the TAT of evaluating, while we currently have a method of valuers going to the land and assessing it. So what's the realistic time frame when we can probably rely on those AI models to evaluate those lands, given the scope of digitization of land records, and how efficient we are in terms of the sensitivity or the recall value of those models that we currently have, and what would be a mature stage that would look like? When can we start adopting that in totality?
So I would share, so it's a place where, of course, it's evolving, it's getting mature. I can share that in metro cities like Mumbai, Delhi, Bangalore, Hyderabad, you are able to at this stage pinpoint to the building and be able to pinpoint to the flat, and still be able to get that how much, what have been the transactions around it, what's the price going on, lot of data, right? In fact, to the extent that it is able to point out and say what were the last deals, how many failed negotiations also happened on some of the trips. So that data is available. But in metros, I agree, there is sizable digitization which has happened of land records and of property records till the tier 2, tier 3 cities also. Land still continues to be open beyond that, but it is there, it is happening. So I believe, as you're asking, saying my personal guesstimate would be is that it's another 4-5 years till the time all records get digitized. And this data gets available, more importantly. But in most of the metro cities at this stage, and when I mean metro 6-7 cities plus the first tier 1, almost 100% records are there in place now. And these are all available on public API. So it's not even that you have to go to any specific service provider. You can actually go ahead and tie up on public APIs.
But sorry, I'll just take 30 seconds more. Is there a risk of ballooning of the valuations, particularly in tier 1 cities, when you look at different data sources, given we have a lot of companies and firms who are valuing these land records, or even the buildings for that matter, or a physical asset. So there's a lot of variance in the evaluation or the valuation amount of that property, if we are talking about that. So probably one particular firm may market at say 1 crore plus value, just taking a random example. Somebody else might value it at below 75 lakhs. So wouldn't there be a lot of variance and a discrepancy, because then each model will have a different outcome, and that too, it will not be closest to a value of say 1 or 2 lakhs. It will be a difference or a variance of say around 50 or 70 lakhs. I'm talking about high value cases also.
Correct. I mean, what you're saying is that I feel that's a challenge which is today there, and I feel that's where the whole point then relies on which model do you want to pick up, right? I mean, and finally every model that you pick up also comes with a cost. Right. So yeah, I mean, that's a balance which the organization needs to strike, right? Saying that how many models and which models would you want to pick up. Beyond 1 or 2 models becomes difficult for any organization to sustain.
Sure. Thank you.
See, and I think just to add to that, right, that's where regular model governance, etc., plays an important role, right? Because you can always go back to data, go back and see how the models have performed. You pick 2 or 3 models, and it's not specific to your use case, but generally, right, when we use AI, what we do is we do quite a lot of back testing, right? And we say how the models have actually performed in relation to reality over the past 1 year, 2 years, etc. And that will then give you an idea as to what some of the variance looks like across the models, which will then help you take an informed decision on where you put more emphasis, where you put less emphasis, and that continuously gets recalibrated.